Today, Kiwis get crushed some more. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and problem news with a distinctively Australian and New Zealand perspective. Well, as expected, the Reserve Bank in New Zealand lifted the official cash rate again by another 0.5% today to hit 2.5%. And the reason this is significant is because they are further up the curve when it comes to rate rising. And yet they're still determined to deal with the inflationary question, let alone what they might be doing to the broader economy. And that's an object lesson for us in Australia, because I think it probably also underscores the likelihood of more RBA rate rises, and pretty soon to boot. Anyway, over in New Zealand, they said that the Monetary Policy Committee agreed it remains appropriate to continue to tighten monetary conditions at pace to maintain price stability and support maximum sustainable employment. The committee is resolute, they say, in its commitment to ensure consumer price inflation returns to within the 1 to 3 percentage point target range. The level of global economic activity, combined with the ongoing supply disruptions largely driven by both COVID-19 and the Russian invasion of Ukraine, continue to generate global inflation pressures. Food and energy prices are especially affected by geopolitical tension. However, the pace of global economic growth is slowing. The broad-based tightening in global monetary and financial conditions is acting to reduce spending growth, and asset prices have also declined due to higher interest rates and a weaker earnings outlook. In New Zealand, domestic spending remains supported by high employment levels, resilient household balance sheets in aggregate, continued fiscal support, and a strong terms of trade. And the reduction in COVID-19 health-related restrictions is also enabling increased demand. Labour and resource scarcity are also contributing to upward price pressure that are currently exacerbated by seasonal illness, a resurgence in COVID-19 cases, and a net outflow of labour abroad. In these circumstances, spending and investment demand continues to outstrip supply capacity, with a broad range of indicators highlighting pervasive inflation pressures. Employment remains above its maximum sustainable level, and the Reserve Bank's core inflation measures are around 4%. The committee acknowledged there is a near-term upside risk to consumer price inflation and emerging medium-term downside risks to economic activity. The committee agreed to continue to lift the OCR to a level where it is confident consumer price inflation will settle within the target range. And the committee is comfortable that the projected path of the OCR outlined in the recent May Monetary Policy Statement remains broadly consistent with achieving its primary inflation and employment objectives without causing unnecessary instability in output, interest rates and the exchange rate. Once aggregate supply and demand are more in balance, the OCR can then return to a lower, more neutral level. And in the accompanying notes, they said that the Monetary Policy Committee discussed developments affecting the outlook for inflation and employment in New Zealand. Members agreed that developments were broadly in line with their assessment at the May Monetary Policy Statement, and the committee agreed it remained appropriate to continue to tighten monetary conditions at pace to maintain price stability and support maximum sustainable employment. They went on to say the committee judged that the global economic outlook was continuing to weaken, broadly as anticipated, and the weaker outlook reflected a tightening of financial conditions, ongoing global supply disruptions, and rising geopolitical tensions. The Russian invasion of Ukraine continues to cause disruption to the supply of oil, gas, and food commodities, resulting in continued high prices for food and energy. And ongoing health restrictions are exacerbating supply disruptions, as currently most notable in China. Globally, they said many central banks have increased policy rates in response to rising inflationary pressures to realign economic demand with supply, and members agreed that global inflationary pressures will likely persist in the near term, as reflected in ongoing high domestic import prices and elevated shipping costs. And members noted that the New Zealand dollar exchange rate has depreciated since the May Monetary Policy Statement, and the moderation in global commodity prices amid a continued decline in investor risk appetite and rising central bank policy rates globally have contributed to this depreciation. The committee noted that the weaker New Zealand dollar is continuing to have an impact on New Zealand dollar import prices. In New Zealand, GDP contracted modestly in the March 2022 quarter. However, this data remains volatile, with a catch-up in government spending and exports expected. Increased visitors to New Zealand are also supporting hospitality and tourism, and meanwhile, household spending has remained resilient despite a decline in consumer confidence. Financial conditions have continued to tighten, with mortgage rates rising in response to and in anticipation of the increases to the official cash rate. Asset prices, including house prices, continue to decline. And members agreed that the increase in mortgage interest rates will assist to bring home prices more in line with sustainable levels. And the committee also agreed that both high food and energy costs and rising mortgage interest rates will lead to more subdued household discretionary spending in coming quarters. And members noted that while there are near-term upside risks to consumer price inflation, there are also medium-term downside risks to economic activity. Despite these risks, members agreed that capacity pressure remained pervasive. Labour shortages continue to be a major constraint for business activity, as are the ongoing impacts of global supply chain disruptions. And a resurgence of COVID-19 cases and a rise in other seasonal illnesses continue to constrain productive capacity in New Zealand. The recent removal of travel restrictions have also enabled a net outflow of labour in the near term. And members agreed that employment is above its maximum sustainable level and that rising wage pressure remains an expected outcome. Meanwhile, core inflation measures are around 4%. The committee discussed the unique shocks the economy is currently facing relative to historic experience, and these developments increase the uncertainty about how households and firms will respond to a tightening of monetary policy. The committee agreed that observing how households and firms are responding to these economic challenges will be important to understand when monetary policy settings will be sufficient to achieve its remit objectives. And the committee agreed to maintain its approach of briskly lifting the OCR until it's confident that monetary conditions are sufficient to constrain inflation expectations and bring consumer price inflation to within the target range. The committee remains broadly comfortable with the projected path of the OCR outlined in the recent May monetary policy statement, and once aggregate supply and demand are more in balance, the OCR can then return to a lower, more neutral level. The committee viewed this strategy as consistent with achieving their primary inflation and employment objectives without causing unnecessary instability in output, interest rates, and the exchange rate. So 3 quick observations. Rates are going to go on going higher, clearly, until inflation is crushed. That's their number one objective. And they're still arguing that household balance sheets are in pretty good shape in aggregate. But of course, within that, we know that there are some really struggling already. And thirdly, they do expect ultimately rates to go higher, but then come back lower at some point. And that's going to be determined by when their objectives are met. So unfortunately, for many households in New Zealand, this means higher interest rates will continue to be applied to mortgages. You might get a little bit more on deposits, of course. That would be quite positive. But there and again, the household debt levels and the very large mortgages that many people are sitting on are going to grind many people down. And they did admit that discretionary spending would be sapped over the next little while. So you can see how they're thinking about the problem. The question, of course, will be whether their approach gets to where they get to, or whether they break something in the process. We'll have to wait and see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.